Hey there, welcome to the channel. So what the heck happened with the market this week? I mean, you're kidding me. My goodness. So let's start off looking at S&P 500. So here it's only down about 9% from the highs. So in the scheme of things, it's not a lot. But what I think we're going to see is there's a lot of damage down in the other areas of the market. And the S&P 500 is such a wide-ranging index. It includes so many companies from all different kind of sectors, et cetera, that it is, it's probably going to be the last one to respond. And I think we've seen that in the past. So let's look at the Nasdaq Composite. Looking at this one, and so what I've done is I've kind of just measured like the move off the high, and so you can see this is down about 15.5% right now. Also, it's really broken the 200-day moving average. Now this is a weekly chart, so that would be the 50. The red is the 50-week moving average, but it's about the same. So you can see that it just broke through that moving average. So this is really important because now you're in a situation where, look, the trend has been interrupted. Is this a market top? It's right now, just looking at that, you can't really say that, but you're definitely in a correction. Now, once again, this kind of crap that they say, oh, a correction is 10% and bear market is 20%, or they have these different like they're not random numbers, like declaring what's a correction and what's a bear market on all these things. As percentages, it's not relevant. What is important is the trend. Are you still maintaining the trend? So in this case, you look at the Nasdaq, you can see from this low in March of 2020, we've been in this constant uptrend. We've had these little corrections. We've had these 3-week periods where it's gone down, 5-10%, but it never was enough and for a long enough time to really just damage the trend, change the direction. Things were always moving. They would stall, go flat for a while, and then start going back up again. So overall, it didn't do the trend. And you can do this by looking at the longer dated moving averages on the weekly chart. As I have here, the red is like, the 50-week, which is similar to the 200-day moving average. So looking at that, you can kind of get this feeling, you can get this sense whether you are still in an uptrend or not. Now, when you break those and you break those suddenly, like we have here, that's damage. And that's really, we're at risk for breaking the uptrend. Now, what can happen with these things is you can have a situation. And so what I'll do is I'm going to draw over here. Let's say we had a market and it's going up like this, right? And then we have a moving average underneath it, which is going up like this. And then we have the kind of situation that we have here today where it's like, okay, now we've had this sharp correction and it's gone down below the moving average. So there's a couple things. I mean, obviously there's an infinite number of things that it can do, but probably one of the best cases at this point is that, yes, this was a steep correction and it finds some kind of a period of consolidation. That would be probably one of the best scenarios where it can consolidate for a period of time. And if it can find a range and hold, then there's a chance that it could continue to go up in the future, right? So this would be like maybe one of your best cases. So just because this bad damage happened, it doesn't necessarily mean that it's going to go down. There's the concept as well is you can have a correction in price, meaning the price goes down, and you can have a correction in time where the market just doesn't make any forward progress and it eats up time. And an example of that is in this period of time here. In this period of time, for this 4-month period, the market really stopped going up. It was just in a range, but it is a correction. It's a correction in time. It's biding its time. It's in a base and it's hanging out before when we come out on the other side, it starts going up again. So you see what I mean? So we have correction in price as we're seeing here, or correction in time as we're seeing here. Okay. So what's really kind of important here is that, look, this is big moves. These are big, quick moves. So now it's kind of skewing things towards something going on, something going to happen. So now what we have is, if we had our market was going up as I was showing, and it was doing its thing, and now we've gotten this thing, we've had this correction. Now what's going to happen? It could just go and keep correcting and going down to some point where it'll finally find support. Another option is it could, and you'll see this a lot in kind of a double topping type thing. Now, or a head and shoulders, or some kind of period where it's trying to get back to the old highs and it can't get up there. And then finally it breaks, and then it goes down, and then it makes this move down. So really, one of the key things about this is that it's amount of the move. Like if you look back here, you see these corrections, it's not as much a percentage moves. Here, it's how fast it moves down and how short a time. So this here, back here, you have a situation where it took 3 weeks for this correction, which looks to be about 10%. And then it actually, in the last week, it actually pulled up and recovered some. So that's like more of a correction. Over here, similar kind of, maybe I'm guessing about, 10% move, but over 3 weeks. And then here, another 10% move over 3 weeks. Here, you've had this 15% move, but you had this 8% move all in 1 week. And then you had a flat week. And then the week before, you had another 8% move, right? So it's the speed at which it comes down. And so what you'll find is that if the corrections are not enough, and it's sort of arbitrary, it's sort of like looking at the chart. Hey, is this a really fast move? Like over here, this is really fast moves. This was like, these are limit down, bam, 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 quick, huge moves in this market, right? Now, what happened is they came in, this is when they were shutting down for this evasive sickness, and they came in and they passed bills, spent a bunch of money, and they really ramped this back up, pulled right out of it really quick. Now, that'll be the question, whether they do the same thing. But that's what you see. So now really the question is, hey, what's going on here? What's going on? Are we in a situation where this is going to be a trend reversal and we're going to start going into a bear market? So you can see also on the Dow that it's broken its moving average. It hasn't gone down as much, but still kind of similar situation. So now looking at more of the speculative plays, like our arcade, this thing's down 50% already from its high. And important things here is that, it had come down into the moving averages and stabilized, and then it just broke down below that. So, you can see this with like the small caps or the speculative plays. Now, RK here is on the smaller cap, but it's also more speculative. You have a lot of companies that it's like, okay, they aren't making any money. So we could look at also like the Russell. Now, this is one that I had kind of been following. And if we look at this guy, let me go over here and annotate it. And I want to show this guy. Yeah. And like I was saying, is like, hey, we have this period, this consolidation here, right? And it failed to break out. But look, we've broken below this. And so when you look at this, it's like, hey, look, you have no support till down here at the 150 range, right? So this thing is now clear. It's clear to just go all the way down. So this is actually really setting up bad. And this is something that, you can see that the speculative stuff will get hit first. The small caps will get hit first. And that can occur, and then it will bleed out into the wider averages. And that's kind of exactly what it seems to be that we have. Now, I've also stated before, like, hey, you have other times where like the small caps will lag or they'll correct, or a particular large sector will correct and the overall market won't respond. And sometimes what that means is it's a sign that, yes, hey, it's a sign that there's a correction coming, a trend reversal coming in, we're going into a bear market. And other times it's not, because other times what you'll see is you'll see periods of outperformance by some sectors and other sectors no. So for example, in spite of all this that's happening, like the consumer staples had this big run before. Yes, it went down the last 2 weeks, but very little, right? So, that's an example of like a leading sector. So it's very, and then XLV here is actually kind of, it started to lead and then it's gotten the crap kicked out of it. And then if you look at some other things like discretionary, it's more on the bleeding edge of getting knocked out. So what that means is sometimes you'll have sectors, you'll have small caps, mid caps, large caps will like lead or go into correction and the market will hold up, et cetera, et cetera. And it's a sign, it's not a sign of anything. It's just that a particular index is underperforming for a period of time. So that's what can happen. So one of the things too is to kind of, I'm looking back at the 2000. And one of the things here as I wanted to look at is I've measured the moves down. And what you can see here is the candlesticks are the S&P, and then this dotted blue line is the Nasdaq. So you can see they both kind of peaked out here. Like the scale is left, right. So they're actually on a different scale. But what you can see is that the S&P went down and the green went down by 50%. But the Nasdaq had gone down by almost 70%. So you can see this kind of different kind of correction. So the Nasdaq at that time in 2000 had a lot of the speculative stocks. That's where your pets.com was, and a lot of companies that have gone and disappeared. And that's exactly kind of the setup that you would kind of expect with like ARK investments, right? There's stuff in there that isn't going to make it. Interest rates going up, it's going to be hard to get that funding. And remember, the funding is hard to get for them, not just because of the interest rates. It's not just because of interest rates. It's also the investors. When I was at a startup, so I'm an engineer by profession, and I was actually fortunate enough to work at a startup in 2000. Matter of fact, we were just getting our funding in 2000, which is actually rather amazing. But what happens is, people that are funding, like the VC firms, the entire investment landscape of investing in private companies, they need something called an exit strategy. And this is something that, working for a startup, they were very clear and straight and very direct with us about it. Like, hey, all these companies investing in us, they want an exit strategy. So it was actually very revealing and nice to know. I mean, the management at that company was very good. They're just very direct with us about things. Hey, we're trying to build a company for the long term. We need to raise money, but you as well need to understand that everyone investing, they want an exit strategy, which means we're either there's a reasonable, some kind of chance or probability we're building to, like, we're going to be acquired or we're actually going to go public. They want that exit strategy. And so in an environment like this, so this is exactly what the issue becomes. So now, in this environment, this is a huge problem for the entire VC industry because they're sitting there, they've made these investments in companies. Now, these are all the companies that are publicly traded, but behind that, there's more unicorns, more stuff that hasn't come publicly come out yet, traded. And so what you're going to see after this kind of stuff, these VC firms, they're going to start not making investments, right? They're going to have to cut back because this is closing the door on their exit strategy, right? So that's a key thing. They need the market holding up because if you're a company and you're not profitable and you need money, you need to get money. Where are you going to get the money? You have two sources of capital. You have I'll summarize as two traditional sources of capital. You have equity and you have debt. Equity is you sell a chunk of the company and you sell it to someone. And that's where VCs come in usually. It's like, okay, I'm going to make a Series C investment of $40 billion, I'm not 40 billion, $40 million in your company, and you're going to give me 10% of the company. That's how it works. But the thing is, those guys are not going to invest. Back in here, they'll invest. They're like, fine, even if it's stable and whatever. But this kind of declining stuff here, this gets to be really a problem. Because why is there a problem? Because they're looking at it and saying, well, okay, this is now getting the crap kicked out of it. they need to know that in a year or two that they have a chance of going public. But yet if this thing is in a bear market and getting the crap kicked out of it, they're going to be less than likely to invest. So now these unprofitable companies, that some of these actually are public and they need to raise money. So it's closing the door on that. Now, of course, they're thinking ahead. This is happening now. And if they're not, the company isn't planning to go public for 2 or 3 years, it may be that they do some investing, but you have to understand that they need that door. Now, the problem is that a lot of this stuff may go down and it may not come back. And that's sort of the issue. Now, the other way to raise money would be through debt, right? And on the debt side of it, interest rates going up, you have to get a competitive rate for that. So that means, if the 10-year goes to 2% in your company and you're trying to raise debt, which is very hard to do if you don't have any assets to back it up. I mean, they're going to charge you 20%, 10%, 20%, whatever it is. They're going to charge you a very high rate. And this going up devalues those bonds, right? So basically, very simple how a bond works. Bonds usually have, they have a coupon, which is a rate that they pay. So if I sell you $100 bond and I pay you $1 a year in interest, that bond has a 1% yield on it. And if you buy it for $100, you're getting 1% return, and the company's paying 1%. But now, if the value of that bond, you sell it for $80. Well, the bond is still paying the $1. Well, what is the interest rate now? Well, it's much higher because you're getting $1 on 80 instead of $1 on 100. So the interest, so the price has gone down, but conversely, the yield has gone up. So the problem is that this reflects the price of bonds going down. Rising interest rates reflect price of debt going down. And so that makes it harder to raise money with debt. So these are all the things that are going on. And so I can imagine at this point that there's going to be a slowdown. Now, this is, of course, what we saw in, 2000. When you go back to the tech bust and you go to what was going on, when this thing cracked in 2000, I guess a couple things to understand about this. So what I want to do is I'm going to go, we're going to use this. That's fine. But the point is, at this peak in 2000 here, right? So at this peak here, right? At this guy here, this started going. But what I want you to look at this thing here. This is 2000. This is the start of 2000. It was peaking out. And this didn't really hit a low. This was still down in the lows all the way in 03. Okay. So what you have to understand as well is, like, this stuff takes time to happen. So during this whole period of time, from the peak in the start of 2000 to 03, you were only starting to build a base in 03. So you're talking about 3 years, 3.5 years, 4 years. So this is something that's going to affect all these companies that need to raise money. This is why this is such a big deal. Because if you're investing in a company and you're here at this area here and you're investing in this company, you're like, oh, well, you're now locked in for 2 years. But here's the problem. Not only are you locked in for 2 years, meaning that you don't have an exit strategy because the market is still going down. They're not going to buy. You're not going to be able to IPO your company. But in addition, the company might need more money. And, that means that if you invest in the company now that needs money and doesn't have profit, then, you need another sucker to come in later. And so this becomes a big issue. These play out on longer time frames than I think people are aware. I know that, you guys are the, you're looking at the intraday charts, you're doing all that stuff. And it's like, I understand, but you got to understand it plays out over a longer time. There's a bigger picture than just the intraday stuff. One thing I just want to show here, this isn't really related to anything, but here's Apple. And what I drew here is sort of, this looks like a Head and Shoulders. And what I wanted to just show is, see, here's a measured move. This little Head and Shoulders has broken down, right? And we're broken below it. But the point is, from the neckline to the peak is your measured move. And that would be the target on the downside would be that same distance as I've drawn here in the arrows. So the downside of this little head and shoulders on the daily charts is only 155, right? And which actually, if you look, is kind of the trend line, right? So once again, if I look at this and I say, oh, it just turns out there happens to be kind of this trend line here, isn't there? Right. And this measured move is liable to come right into the trend line at 155. And whether that'll be the case or not, I don't know. But what I want to point out about technical analysis is this is the kind of thing that it tells you. It can tell you that, hey, there's a setup. You know, what's really happening here is, look, you're not making new highs. You're failing to get to new highs. You almost did here, but then over here, you really failed. And because of that, now you're set up for a downfall. But the thing is, it's only a small downfall in this particular case because you're on a daily chart. So now if we go over here and we take this to the weekly, what's going on with Apple? What's going on with Apple? Well, look, full on uptrend intact. Right? No actual risk at this point of a trend change on the long-term chart. So one thing to keep in mind when you're looking at these technicals is you have to deal with the time frame. If you're looking on a 15-minute intraday chart, the consequence of a pattern that shows up on there, a technical analysis on there is on that same time scale. That head and shoulders on the daily charts has a little bit of an effect. I mean, we have a down week, but in the big picture for this thing, when you're looking at a 2-year weekly chart, is no effect. So technical analysis ahead. So what that means is when you see something like there's a double top, a triple top, there's a head and shoulders, and we broke below the neckline, you have to look where that is to see how relevant it is for the situation that you're in. If you're day trading, intraday trading, then yeah, it matters. But if you're not intraday trading, it may not matter at all. So just kind of try to keep that in mind. So the big picture, to summarize here, we may really be facing a market trend change. That's kind of what we're seeing here. It could be, it's speculative, right? I mean, I don't have an actual kind of top pattern in. I have on many of the indices, you know, we're just cracking the moving averages right now. You know, we're just cracking those. And even on the S&P, we're not cracking it yet. But the problem that we have is you can see the damage in other indices. And you can see like the Nasdaq getting beat up. You can see the small caps, Russell, getting beat up in this now with the death cross and everything. So you can kind of see the setup. As more and more stocks get drawn in to a correction, it gets harder for them to hold up. And so what I suspect is happening is that we probably have a trend change, and that's what it looks like to be. Now, the problem is, does that mean the market crashes? How low does the market go? That's really hard to say. Like if you look at the Russell, where we're at here, look, there's a bunch of support in this area here. So, you know, my expectation would be at least at some point, you know, somewhere in this range, you probably find support. And then the question is, well, okay, where does it go? Does it do this and then does it go, or does it just stabilize? I don't know. But it definitely would urge caution at this point. The other thing I wanted to look at, if I can check this out. See, really wish my computer would not be so freaking slow. It's pissed me off. Okay, I want to look at Cisco systems here. And so what I'm really trying to point out here, and I brought this up in one of my other videos, was that, hey, the leaders of the past may not be the leaders of the future, okay? And so I really wanted to, you know, look at some of these. Back in the late 90s, so over here, back in the late 90s, this guy here, Cisco, was one of the bombs, the leading stocks. This thing, look, it was coming up in the late 90s. I mean, look at this. price suggested it was at like 2.5, $5. And then within a couple of years to the peak, it was at 57. So you're talking like whatever, there's multiple X returns in this move up, right? Because Cisco was part of that whole tech boom that was going on. It was part of that. That's what drove a lot of the tech bubble, is in companies like Cisco were the leader. Now they came all the way down and they basically got their butt kicked. But the important thing that I want to point out is this stock, look what it did. It did nothing for a decade. So this leading stock, after it came down, it wasn't like it continued to crash. It didn't go to zero. The company's still around and a big company, and it has, whatever issues that it has, but it's still, it's around. It's a competitive company. It's probably not going anywhere. But my point is that this stock did no longer lead for the next 10 years. This stock went nowhere. And there were many, many companies that were in a similar situation after the tech bust. So that's my point. Now, they came up and they actually participated in this latest round, and they did. Okay, fine. But I'm focusing on this 10, 11-year period where it did nothing. Okay, so this really does show that the leaders of today may not be the leaders of tomorrow. And so when you look and you're saying, so this is what I really want to get to here. So if you have high conviction in something like Tesla, right, which is like, fine. I think they're a good company. I mean, at least they have some profit and they're making stuff and real products. But my point is, compare this chart to the one that I just had, right? Compare that to the one we just had. We had Cisco, which had this huge move, similar type move, and then it went down and it spent 10 years doing nothing. So that's potentially what can happen here. So when you have these leaders and you're talking about high conviction and you're like, hey, high conviction, I'm going to buy the dip, buy the dip, buy the dip. Okay, fine. At some point, you're going to buy the dip. Maybe it'll be down here. The company's still around. This company's still selling billions of dollars worth of stuff, but the stock isn't going anywhere. And that's what you need to be careful of. That's what my caution is to you. If we end up in a cycle and this is a change in trend and the cycle is over, we're going to start another cycle, is what I'm trying to say. And if that's the case, if that's what this ends up being, then these current stocks, which are basically the ARK-K stocks, they may not lead and they may not do anything for 10 years. So I would just urge caution on that. So that's it for this one. Is it a market top? I don't know, but you really need to be careful. That's it for this one. Bye.